Hey, Steve Livingston here. I just wanted to do a refresher on the Seed Enterprise Investment Scheme, SEIS. Asked about it more and more, so I thought I'd just do a kind of quick bullet points, banging through the key things to be aware of. It's just for awareness. There's no detail as such. Just if you're a founder of a UK company looking to raise funding, or if you're a business angel, or you just want to help invest in UK startup companies, then this could be of use to you. So you can see the list of the points we're going to run through here. I won't read them all out. Let's just sort of dive straight in. So first of all, what is SEIS? So SEIS stands for Seed Enterprise Investment Scheme. You may have heard of the Enterprise Investment Scheme, which is like a larger version. Seed comes in to help the earlier stage companies. It's a UK government tax incentive that aims to encourage individuals to invest cash into early stage UK companies by giving tax reliefs to the qualifying investors. And we're going to dive into more of that in a moment. Point to note straight away, under SEIS and EIS for that matter, it's got to be an investment in a new issue of ordinary shares for cash, can't be loan conversions, with no preferential rights. I say preferential rights to assets on a winding up or to dividends. So got to be an issue of shares, can't be a loan, just point number one. So for some founders already thinking, no, I don't want to be diluted. In that case, not for you. It's got to be an issue of shares. That's how this whole relief works. Who benefits? So the investors themselves receive the tax benefits. Say it's a UK government tax incentive and the investors get the tax benefits. Founders, the company gets the benefit indirectly in the sense that you now have a whole army of potential investors who might not otherwise be interested in investing in a private UK limited company. I should say here, caveat here, I'm saying UK limited company, you can have a permanent establishment. It could theoretically be an overseas company, but let's keep it simple here. If you want to dive into that, please reach out to me. Why is SEIS important? So most investors will expect you to qualify for SEIS and or EIS before they invest in you. It's become a kind of a given that one of the first questions you'll get asked, if you go to any pitching event or you go to any investor, seasoned investor, saying, I want to raise money, this is my, the valuation of the company, this is the amount of shares I'm willing to give. You imagine a typical Dragon's Den scenario. They will, in 99% of cases, expect you to be SEIS and or EIS qualifying. So one of the first questions would be what SEIS allowance do you have left, or are you SEIS qualifying, or all those questions around that. So having awareness of this is absolutely key. You don't have to understand all the rules, but just having a broad understanding is so important. So that's point number one. I say Dragon's Den themselves, we know for the fact that they do use that and they're all over these reliefs in terms of the dragons, but in real life, this is massive. The other thing is the tax benefits of SEIS make up for the illiquidity of investing in a private limited company versus, say, the stock market. What do I mean by that? Well, if you think about it, if this relief didn't exist, if you've got a business angel, some high net worth who's got a pile of cash they want to invest, ordinarily they're just going to default to the stock market, bond market, or your usual kind of commonly accepted listed markets. And the reason for that is mainly because if they want the cash back, they can just during market hours press, sell, trade, and get the cash back and get the cash out of the marketplace. If you contrast that with a limited company, if you invest in the shares of a UK private limited company, there's no ready market of buyers. So, it might be pretty much worthless for the opening years until the product or whatever has been developed. So the money's trapped, essentially, in a private company. So people need incentives to part their money to put into a private company versus the more commonly accepted routes of going to listed markets. So that's kind of why it's so important. Same applies to EIS as well. So who is SEIS for? Okay, so it could apply in theory to the vast majority of UK startups, in all honesty. I put Topco there in brackets just because what I mean by that is, we sort of touch on it in a moment, but it's got to be a company that's not under the control of another and can never have been under the control of another company for SEIS. So if you're in a group situation, it's got to really be the top company that would be the one issuing the SEIS shares, and the subsidiaries have got to fall under it. There are kind of certain rules around subsidiary companies, so be aware of that. Because it's beyond the scope of this video, but just be aware. If you're a standalone company, it's dead simple. The UK company has to have been trading for less than 3 years. Note, incorporation date is irrelevant. So this is a really common misconception. It used to be 2 years, and this is where the seed bit comes in, Seed Enterprise Investment Scheme. Seed is for early stage, it means early stage companies. And the rules since 6th of April 2023 are that it can't have been trading for more than 3 years. And it's trading you're looking at, not incorporation date. So in principle, you could have incorporated a company 6, 7, 8 years ago that's never done a thing, and now you want to use it for SEIS. That's absolutely fine. You can do. It could also be the case that that company that was incorporated 7 or 8 years ago, you are going to spend the next 4 years developing, raising money and SES, and you're then going to develop this new piece of software, this new product, whatever it might be. And therefore, you've got the 8 years plus the 4 years. You're still within the SES window because you haven't started trading yet. It's when you kind of flip the switch to start accepting customers, start issuing invoices, sales invoices, put your website live where you're accepting orders, all that sort of good stuff, that basically shows your shop is open for trading. That is when the 3-year rule kind of kicks in. And beyond that date, then your 3 years, you can't raise any more money under SES after that 3 years is up. Less than 25 employees and total gross assets of less than 350k at the time of the date of the share issue under SES. So you can't exceed those. So less than 25 employees, normally pretty straightforward for most early stage companies. The total gross assets is basically referring to, say, you've got cash in the bank. This doesn't include the SES money. Take a snapshot of your bank account, your maybe debtors, accounts receivable, any fixed assets you've got at the moment before you issue the shares. It's got to be less than £350,000. That's basically what that means. And you must not be undertaking excluded activities to any substantial extent. What do we mean by that? Well, there's a list of excluded activities. I'll put a link below that are not eligible, and substantial extent here means can't be more than 20% of your activities. Things like, a lot of it's quite obscure, but it's stuff like, hotels, being involved in banking, like making loans, insurance, market gardening, shipbuilding, coal, steel, legal and accountancy, quite interestingly. One thing to note with, and there's also a really odd rule about royalties and things. I've got other videos around that. So be careful, I'll say here now, be careful with things like university spin-outs, where you're perhaps a SaaS or something like that, where you're going to accept your primary source of revenue is going to be royalties or license fee income. Now, for SaaS-based companies, it will often be license fee income. And if you're a spin-out or something like that, just check the rules around that, because there's certain traps that can catch you, and it goes beyond the scope of this. And I've got stuff in my archives you can find around that. So beware of that. The other thing to be aware of is if you are, you might think, you mentioned banking or insurance, and we're developing some sort of fintech software in the banking industry or the insurance industry. That doesn't necessarily count you out. It's more like, if you are involved in banking, if you're just facilitating the software to help the architecture, the infrastructure, that should be fine. But this is where the whole, I touch on it in this later on, you can go to HMRC for advance assurance. It's like pre-approval that you are a qualifying company. And that's in that sort of area there, that's really useful. You can check that out and say, we are in the banking industry, but we're not a banking company. You can sort of spell all that out and get kind of the rubber stamp from HMRC on that before you go ahead and take the investor's cash. Okay, who is SES not for, just as importantly? So, as we already alluded here, companies that have been trading for more than 3 years are counted out. Companies that have acquired the business that is 3 years old, kind of weird word in there. What I'm trying to say there is, what you can't do is say, right, okay, well, I started a company 5 years ago doing X, Y, Z, been trading for 4 years, and really want to raise money. Wish I'd heard of SES before. I know what I'm going to do. I'm going to set up a new company, and I'm going to transfer that trade into this new company and kind of phoenix it. You can't do that. You've got to follow the breadcrumbs back to where the predecessor trade started. So if it started in, say, your other company and it's more than 3 years old, you're stuffed. Likewise, if you buy it from a third party, you'll look how long they've been trading for. Longer than 3 years, you're stuffed. So just counting that that year. And if it's less than 3 years, well, you've got to add it on. If they've been trading for a year, or you've got 2 years within your company. That's for the total of 3 years. Companies that subsidiaries are under the control of another company got to be top company, basically. Companies that have already raised funding under EIS, you can't have EIS first and then SEIS, or issue shares under EIS first and then SEIS. It's always SEIS issues first, EIS shares second. Got to be at least a day between them, ideally. Companies that are capital intensive, but potentially, and or excluded activities or heavy on excluded activities. What I mean by that is HMRC have a preference for companies that are not capital intensive, because what you're doing, if your business is built around, buying a pub or something and building a chain of pubs and your trade out of them, the problem with things like that, I'm not saying it won't qualify, but you've got to take care of these particularly, because you're, in HMRC's eyes, I understand them. You can understand why. These tax reliefs are very generous, which we'll come on to in a moment, and they're not intended to assist companies that kind of de-risk themselves. So if you think about it, if you say buy a building and you operate out of it, and that business that you're operating fails, but you've got a property that's just appreciated in value that the whole time, and you just sell the property, get the cash back for the investors, and you all walk away none the worse off. That's not what this is intended for. There's got to be a genuine risk to the capital of the investors. And it's very likely that if you've got a capital intensive business, as in you're buying properties and things, that you're going to fail that risk to capital test. Kind of makes sense. The other thing is slimline companies, kind of linked to that really, on these almost on the fast, the opposite of it is building a company where you're saying, right, okay, so I'm just going to just set up my company, I'm going to outsource or subcontract all the activities for the work. We're just going to just trundle along quite nicely, and we should get the money back to the investors, and then we'll just move on. What HMRC want to see is genuine endeavours for profit and growth. So they want to see what I call, rather than slimline, they want to see a full fat company. They want to see that you are investing in employees, that you're investing in a brand, that you're looking to really grow the company. I mean, if you don't achieve it, you've got aspirations for growth. And you're not kind of playing it safe with kind of outsourced functions where there's no real kind of meat to the company. Again, that's like to fail the profits the intentions to develop for profit and growth. And then finally, lifestyle business. I said there's nothing wrong with having a lifestyle business. In fact, all for it. But the problem here is your investors won't be all for it. If you think about it, they're putting their cash into your business with the intention to realise that gain over time. And if you're trundling along thinking, this is wonderful, I'm getting these dividends and it's going great guns, I'm really enjoying it, I'm going to carry on for the next 20, 30 years, then your investors are going to get a bit upset because, as I say, they want to recycle their cash or at least realise their investment. So lifestyle businesses doesn't suit. You really want to go into it from the beginning with an expectation that you're going to sell within 3 to maybe 10 years after the receipt of the investment cash from the investors. So it doesn't suit lifestyle businesses so much. It's for growth businesses. How much can I raise under SEIS? Okay, so you can raise up to £250,000. It was £150,000 previously, up to 6th of April 2023. So it's not a bad amount. 150,000 was too low. 250 is getting more like it. But for many companies, still, it's not enough. So what you can look to do is arrange to have a follow-on or top-up with the EIS. So there's nothing wrong in principle with saying, right, I want to raise £1 million, and the first 250 is going to be under SEIS, and organising that with the investors who's going to get that SEIS. Maybe have a bit of a race to see who gets the cash in, this sort of things, so that you can get it, or you could do it on a pro rata basis. There's various ways you can cut it to get to the right results, or an equitable result, should I say. And just taking care, though, that when you do issue the shares, you get the right order. So your SES is first, and then your EIS. So make sure you do that right. Okay. Also, I should add, you've UK citizens, investors, we've got a £200,000 allowance. So I'll come on to that now, some of what the tax benefits. So we all have a £200,000 annual allowance, runs from the 6th of April each year to invest in SES companies. What are the SES tax benefits? Well, 50% income tax relief. 50% income tax relief on the initial investment. So say you put in 50 grand into a SES company, you can reclaim, shelter 25 grand of income tax. Now, be aware you've got to have that income tax liability to be able to shelter it. So, and you can look at the current tax year and the previous tax year. There's no point. As I said a minute ago, you've got £200,000 annual allowance. There's no point putting £200,000 in, thinking you're going to get £100,000 income tax relief when you've only suffered 50 grand over the past 2 years. You can kind of do the maths. You can say, I've had 30 grand that I've suffered over the past 2 years. Therefore, if I put 60 grand in, I can get that back. Massive. CGT free sale after 3 years. Potentially even bigger. So you imagine that scenario, you put your 60 grand in, you get 30 grand income tax, 50% on the way in, and then the company sells for 6 million, or your share of this is worth 6 million. I'm stretching numbers here, be amazing, could happen. 6 million after 3 years, then you can sell that 6 million's worth of shares tax-free. Given the change in the recent budget on capital gains tax, and also the fact that the entrepreneur's relief or business asset disposal relief, as it's now known for the founders, is being kind of tapered down or away, then you can see the investors are getting a fantastic result here to have CGT tax-free sale. IHT benefits, I could put benefits there, not as good as it was, again, due to the recent budget, but you're going to get a reduction in IHT after 2 years. And potential, there's a kind of funny rule where you've got potential reinvestment relief for capital gains that you've suffered elsewhere, where basically say you've sold like a flat or something, or a second property during the tax year, you would be suffering capital gains tax on that. You can basically offset 50% of that capital gains tax if you reinvest into an SEIS qualifying company. So kind of hard to get the rules to fit, but it can work, and it's one to be aware of. What are the downsides of SEIS? I think, first, you can't run away from the fact that there are massively complex rules around it. Unfortunately, especially given as it's aimed at startups, early stage companies, it's a shame that the rules are quite so complex, but they are, and there's things that can trip you up along the way. Form filling, you get your advance assurance at the beginning to get into HMRC. You don't have to do that, but you'd be mad not to, just because it gives you and your investors that comfort that in all likelihood you qualify. Flying blind, getting the money from the investors and praying that it all comes good later on is potentially a recipe for disaster. Being aware that, once you get the shares issued, you then need to go back to HMRC with the compliance statement, responsibility of the company to file that form SEIS 1, and that then gets the tax certificates for the investors. So you have to do that as well. And then need to stay compliant for 3 years after the share issue, and each share issue that you do, that kind of that runway can keep extending. And it's things that why I say mean stay compliant is you've got to make sure you don't do something that jeopardizes the relief for the investors. So it could be something quite innocuous, you might think, but changing capital structures, acquiring companies, they're doing little things you might not realize. I've seen all sorts over the years that companies have done. They come running to me and they're like, what have we done? We didn't realize this would impact the rules, and it does, and it can just unwind the relief. And you can imagine, you take that scenario of 60 grand in, 30 grand someone's got back, their shares now worth 6 million, and you do something and that all falls away, and they have to pay back the 30 grand, and they have to pay tax, capital gains tax on that £6 million exit. Nasty conversations. And managing investor expectations for exit. That's something to be aware of is, you have got that, and you might change your mind after a few years thinking, I'm really loving this business, it's going so well, I can't imagine doing anything else. And you've then got investors who are kind of scratching away to get out and asking you about what the plans are for an exit. So managing expectations around that is key, and it's something that it's not for everyone. Not every business founder needs that pressure. So being aware you've got to get that pressure after 3 years to find an exit. And finally, the investment limits are relatively low, so you normally need to combine with EIS, and that adds the complexities I've already alluded to, trying to make sure that you get the timings of the share issues correct in terms of SEIS first and EIS after. So that's a kind of real canter through. I should put a disclaimer, this is kind of a high-level refresher. Get advice for your specific circumstances, and you can reach out to me. I've got a whole bunch of videos on this sort of stuff you'll find here on YouTube and on my website. And if you need any specific help, please reach out, because I say it's a bit of a minefield, but it's still a phenomenal tax relief for founders and for people who want to invest in startups too. So I hope you found that useful. I'll try and put a link to this document as well so you can access it. But yeah, my name's Steve Livingston. Thanks for watching. Please subscribe if you found this sort of stuff useful. Leave a comment, any questions, and then thanks for watching.